But there's still plenty that can go wrong. The world's largest beer maker, AB InBev, is poised to acquire its closest rival, at least in terms of size, SABMiller. Now, the board of the British South African company has agreed on the key terms of a revised potential takeover offer that values the company at $106 billion US. If the deal does go ahead, this new entity will make almost a third of the world's beer, 1 out of every 3 bottles in fact, and it will rank in the top 5 mergers in corporate history. SABMiller has a secondary listing in Johannesburg. It employs over 6,400 people in South Africa alone. There have been concerns, however, in that country over what effect this takeover will have on the local economy. South Africa's National Treasury, for example, said it could, quote, in the extreme, end of quote, try and block the move over tax erosion concerns. In the meantime, South Africa's Food and Allied Workers Union also says it plans to oppose the acquisition primarily due to job loss concerns. Let's dig deeper into this proposed corporate marriage. Chitra Norbat is live in New York. Angelo Coppola is joining us as well from Johannesburg. Angelo, let's start with you. We've had lots and lots of objections today from the Food and Allied Workers Union, the Treasury, with a couple of caveats as well. Let's start with the latter. Why is the Treasury concerned about the potential for tax revenue loss?
Well, Raman, I feel a little underdressed. I'm not wearing my wedding tux, but the issue really is the fact that the tax erosion is, as an analyst tells me, you'll recall that SABMiller is a London company and they've been there for years. So there are no real issues in terms of tax erosion. There are 6 breweries in the country and there's some 15% of the revenue that SAB generates comes from South Africa. So we're not quite sure what the issue is here. For a clue, an analyst said to me earlier that perhaps Treasury is thinking that they want their pound of flesh. And if you think back to the Walmart Massmart deal of several years ago, this is what he's citing. The companies in that instance wanted the deal and bent over backwards to try and accommodate everybody, and specifically the government's requests. So all kinds of programs and deals were struck for that particular merger or marriage. It's also helped some local producers, in fact. So SABMiller will probably entertain some conversations with the government and will look to try and meet some of their demands, the analyst was telling me. There's also the question of the $3 billion break fee, which AB and InBev will probably pay if the deal falls through. So both parties are going to be working extra hard to see that this deal does work for everybody, including National Treasury. Raman?
Indeed. Unfortunately, we have lost Chitra Norbat live in New York. Angelo, let's keep back to you now. What about the union objections to this deal? They've cited potential job losses, at least in the statement that came out from the Food and Allied Workers Union earlier today. Are those fears valid? And if they are, what can they do about it?
Raman, the analyst I spoke to suggested that the contrary is probably possible. It's unlikely that AB and InBev are going to import brands into South Africa that they can produce in country, for example, at those 6 breweries that they are going to own if the deal does go through. So it's likely that this deal will probably enhance jobs and probably create some new jobs here. The union may be a little anxious because on the sidelines there's a consolidation that's happening between SABMiller and the Coca-Cola company in terms of African distribution. And the union says that that particular deal may lead to white and blue collar job losses because of rationalization. But in the beer sector, there are no overlaps with these 2 brands or these 2 groupings in the country. And you know what? If there are job losses, Roman, you know what, we're in strike season in South Africa right now. So it's likely that the union FAWU might consider some strike action. But I mean, that could be months or even years away.
Indeed. I understand we now have Chitra back on the line from New York. Chitra, slashing a tax bill here, isn't that a big part of the potential benefits of this particular deal, assuming that the combined firm does eventually move out of its current tax domicile out of Belgium, say, into the United Kingdom?
Rama, taxation is a significant factor in the deal. Investment bank Nomura says that tax was a big consideration for SABMiller shareholders like Altria. And so depending on how the deal is structured, that's what they're going to be looking to do, is how to mitigate the significant capital gains tax owned by SABMiller's top shareholders. In a deal like this, optimization is key. So that's why companies get together. That means cost and infrastructure efficiencies. And a big part of a global company's cost base is taxes. So optimization is a focus. in these large global companies, it's very complicated. Divestitures are inevitable here to get around the antitrust issues, so the tax lawyers will be looking to find the best jurisdiction for the combined company.
Indeed. Finally, Chitra, I mean, let's look at the underbelly, the ugly, if you will, underbelly of this corporate wedding. AB InBev needs roughly $70 billion in financing in order to close the deal. How will this be structured? And isn't this company racing against the clock here to raise the required money before the Fed starts to raise rates?
Shareholders will want the deal to be structured in a way that minimizes taxes. So there are a couple of options, say the analysts. One is equal split of cash and equity. Anheuser-Busch InBev is working to arrange total financing of $70 billion, as you just mentioned. So this would apply a debt equity split of between 40 and 60%. Now, this would still incur a big tax bill for shareholders like Altria, with roughly half of the consideration in equity. Capital gains payable would decline. Another option is a cash offer with equity option component. Nomura says it's not sure if there's a chance for ABI to offer 100% cash for SABMiller, but with the option to take shares at a discount with a lock-in period like over 3 years. Most institutional investors would want the higher cash option. However, longer-term strategic investors such as Altria or the Santo Domingo family could elect for equity. While this would overall reduce their overall consideration, it would mitigate against a punitive capital gains payment and allowing their existing stake to be rolled into AB InBev equity. And when it comes to the $70 billion that AB InBev needs, companies like this have a lot of cash tied up all over the world in their operations. So they'll look at borrowing and credit lines, but more importantly, this combined entity will probably have to make divestitures and sell assets to get around the antitrust. So that will be present and future sources of cash.
Indeed. We'll leave it there for the time being. Thank you both for your input. Chitra and Norbert, they're live in New York, and of course Angela Coppola in Johannesburg.